This is the Retirement Lifestyle Advocates radio program. I am your host, Dennis Tubergen. Glad you decided to tune in today. Hey, it is still January, which means I have the January special report, and you have one more week to order it. The January special report is titled Two Possible Outcomes, and the report talks about the fact that, from my perspective, the Central Bank of the United States, the Federal Reserve, has painted itself into the proverbial corner as far as economic policy is concerned. And the bank has two choices moving ahead, and both choices are bad. Each choice will lead to a different potential outcome, in my view. I outline those in the report, and I give you some strategies to consider for your own individual financial situation. To get a copy of the January 2023 special report titled Two Possible Outcomes, as well as a copy of my best-selling revenue sourcing book and a copy of the best-selling book, The Little Black Book on Social Security Maximization, as well as some other resources, just visit requestyourreport.com. Let me know where to mail this box of information, and I'll be glad to do so absolutely free and with no further obligation. Again, the website is requestyourreport.com. Now, if you've been a long-time listener to the program, you know that it's been my view and the view of many of the guests that I interview that the U.S. economy, really since the financial crisis, has been fueled by central bank easy money and, more recently, central bank easy money and government stimulus. Well, now that the Fed has started in 2022 this tightening cycle by increasing interest rates, and now that government stimulus money has pretty much evaporated, we're now seeing signs that the economy is reverting back to reality. And it's my view that as the economy reverts back to reality, it's going to be painful. Now, one bit of evidence I found this week in an article published by Wolf Richter, and it dealt with the fact that delinquencies of subprime auto loans are now approaching all-time highs. In December, the subprime auto loans 60 days and over delinquency rate rose to 5.7%. That means about 6% of all subprime auto loans are more than 60 days delinquent. In other words, 2 payments behind, assuming that these borrowers need to make monthly payments, which is typically the case. Now, if you go back and take a look at August of 2019, that's about where we were then. Now, interestingly, at the peak of government stimulus, that subprime delinquency rate dropped to about 2.5%. Now, a subprime borrower is a borrower that doesn't have great credit. So it stands to reason that while government stimulus was floating around out there, that these borrowers could make their payments. Now, however, the government stimulus is no longer there. It makes sense that now we are reverting to reality. Now, Bill Holter, who is a financial writer, and he writes a lot on the topic of precious metals, provides another bit of evidence, or maybe I should say provides a fact that I believe will create some economic headwinds moving ahead as well. He said last summer in an interview that Fed rate increases would tank the economy as we move back to what I would call reality. And as we've been talking about here on the program, you're starting to see signs that this is actually the case. The economy is starting to slow. I happen to believe that we're likely back in a recession at this point. Housing prices are starting to drop. House sales are down. Banks are now recording losses and talking about layoffs. Vehicle prices are falling. Part of the reason for that is that we're seeing defaults increase on these loans. Unemployment is rising. Now, Holter points out, in his view, there is more than $2 quadrillion worth of derivatives outstanding. Now, these derivatives are typically credit default swaps. They're side bets, if you will, between banks. They're basically insurance policies in which one bank will insure the portfolio of another bank, typically against a big change in interest rates. Now, unlike traditional insurance policies, which an insurer would have to reserve for a claim, this entire market is unregulated. And Holter says there's $2 quadrillion worth of derivatives out there. Now, if you compare that to the financial crisis, that's about 8 times the derivative exposure that existed at the time of the financial crisis. So this can't possibly have a better outcome. He points out that when derivatives go, they go quickly. He calls it a 48-hour event. Now, he points out that all the big banks own these derivatives. He has a bit of an off-color analogy. He said it's like one giant financial STD, and everybody is in bed together and everybody is infected. So when these derivatives go, it's going to affect everyone. As I recently talked about in my Headline Roundup webinar, there are more headwinds for the U.S. dollar in that Saudi Arabia announced that it will now accept payment in currencies other than the U.S. dollar. So you have the makings here of more inflation. Now, Holter noted that it's his view that other Arab nations will follow. And that will be a huge hit to the artificial demand for the dollar. And many of you who are longtime listeners know the backstory. Back in 1973, Henry Kissinger and I believe the Treasury Secretary at the time put together an arrangement with Saudi Arabia that Saudi Arabia would export all their oil in U.S. dollars in exchange for the U.S. protecting Saudi Arabia. Saudi Arabia now is cozying up to other countries for their protection, and they now, just in the last couple of weeks, have publicly announced that they will now accept payment in other currencies, not just the U.S. dollar. That will, over the near term, mean that there is less demand for U.S. dollars internationally. There are other options as far as currencies are concerned. If you want to trade with Saudi Arabia and other countries, that will likely mean these dollars that are being inventoried by other countries are going to come back to the U.S., and that will be a hugely inflationary event. And that brings me really to the topic of my January special report. And if you're just joining me, if you'd like to get a copy of the January special report titled Two Possible Outcomes, that outlines the two options the Federal Reserve has moving ahead, go ahead and visit requestyourreport.com, and I'll be glad to send it out to you along with all the bonus information. But the Fed really has a choice between saving the dollar or saving the financial system. And as Holter said, it's his view, and I would share this view, that they can't save everything. Something has to break. Holter went on to say this, quote, "The best way to sum it up is the facade that we have lived our lives through is ending and will completely end. The reality, as we return to reality," those are my words, not Holter's, Holter says it's going to blow people's minds. He said the Fed has always feared a deflationary collapse where it can't inflate or reinflate the system. Credit is the foundation to the whole system. If credit cracks and credits collapse, it means the foundation collapses and thus the entire house. So again, if you have not yet requested the January special report, I would encourage you to do that. It's titled Two Possible Outcomes. All you need to do is visit the website, requestyourreport.com. I'll be glad to send you a copy of the report, along with a copy of the best-selling revenue sourcing book, as well as the best-selling book, The Little Black Book on Social Security. I'll also include a couple of recent client newsletters as well. So visit requestyourreport.com. Let me know where to mail that information. I'll be very glad to get it out to you. I will be back after these words with my special guest, Dr. Bob McHugh. Welcome back to RLA Radio. I'm your host, Dennis Tubbergen. Joining me once again on today's program is returning guest Dr. Robert McHugh. Bob is the probably one of the hardest working technical analysts in the business. His website is technicalindicatorindex.com. The website again is technicalindicatorindex.com. And I've been a longtime follower of Bob's work. And Bob, welcome back to the program. Always nice to catch up with you.
Thanks, Dennis. Always great to be here with you and great to be back.
So, Bob, as we're sitting here and the first month of 2023 is drawing to a close, as hard as that is to believe already, give us your assessment of the U.S. economy. Are we in a recession? Are we headed there? What's your take?
Well, I do believe we're in one, and I do believe we're going to go into a deeper one. And I think that the problem is that the inflation rate, although they say, mainstream media has been harping that, oh, we're in the right direction and so on, it's still over 3 times greater than the maximum target that the Federal Reserve has set for inflation. It came in over 6%. Their target maximum is 2%. We're a long ways from getting there, which I think means that the Federal Reserve will continue its rising interest rate policy strategy for a lot longer and a lot higher than anybody may be thinking at this time. And the markets, are kind of hoping that the worst is over. You can tell that they feel like the Fed has accomplished their goal. It isn't anywhere near accomplished their goal. And one of the problems is the Fed can raise interest rates very, very high, and all they're doing is reducing aggregate demand. It just means people have less money to spend on goods and services. They're going to have more financial hardship. Households are going to struggle more because interest rates are higher. The real problem with this inflation is not about aggregate demand. The real problem with this inflation is about aggregate supply. There is a shortage of supply of goods and services for what people need and want at this time.
So, Bob, I'd like your take because I interview a lot of people on the program, and there seems to be, I won't say an even split, but an almost even split of those analysts and prognosticators that say that the Fed will stay the course. They'll continue to increase interest rates, even though maybe it'll be a little bit more gradually than they have in the past. And then there is another group, and I would probably be leaning more toward this group, that think as the recession intensifies, the Fed might throw in the towel on inflation and decide that the economy needs more stimulus, and they'll reverse and go the other direction. Well, what's your take on where the Fed might go if this recession does indeed intensify from here?
Yeah, I guess I'm kind of straddling both sides. I think initially they'll continue to raise interest rates and disappoint the markets, and it'll become evident that the recession's getting deeper. And at that point, the recession will get pretty severe, and then they will have to reverse eventually their policy, give up the inflation target so much, and go back to trying to stimulate the economy. But I think that period of time is pretty far off, unless we have an event very soon that would tank the market and the economy. I think that it'll be a gradual, continuous rise in interest rates, longer and further than people wanted. The recession will become very evident, become very severe, and then they'll reverse. So I guess I'm kind of straddling both sides.
Yeah, fair enough. So when you look, Bob, at the U.S. economy, it's dependent on consumer spending, and inflation has certainly robbed a lot of American households, particularly middle class households, of their discretionary income. Doesn't this inflation that we've seen and the price increases that we've seen? I mean, typically you don't give these prices back. Hasn't this damage that really inflation has done? Isn't a lot of it just permanent in your view?
I do think it's permanent. I agree. I don't think you're going to see things drop in price ever again. You'll see this maybe plateau out, and this will be the new base. But I agree with you. I think that this is permanent damage here.
Well, I'm chatting today with Dr. Bob McHugh. His website is technicalindicatorindex.com. I would encourage you to check it out. So Bob, let's dig in a bit here. I read an article this past week that it seems central banks around the world are now accumulating gold. Seems like they're maybe trying to get assets on their balance sheets that may protect them from their own policies. What's your opinion on that? And then where do you see precious metals markets going as this recession intensifies?
Yeah, I mean, that's a great question. What I see gold doing, it's stuck in a handle of a large, gigantic cup and handle pattern, which is a bullish pattern. It started back in 2012, the cup part of the pattern. It's now in the handle. It's been in the handle since 2020, and it's just an oscillating up and down series of moves where it kind of ends up going nowhere. But the way these patterns work is once the gold price rises above out of the handle, which means above 2100, then it'll explode higher, and this gold will explode higher. So something the charts are telling us, and I believe the charts are the accumulation of all knowledge on the planet, all set in pricing. I believe that gold will head substantially higher once we're out of the handle. But now this handle has been going on for almost 3 years, and so it's going to require possibly some patience before this breakout. But once it happens, gold's going to go much higher, and it could mean there's going to be real trouble, geopolitically throughout the globe, if that's the case, because gold has been considered a safe haven, and like you said, they're building up inventories of it to back up currencies and so on. So I do think that's headed much higher.
Bob, when you look at some of the things that are happening around the globe, Saudi Arabia just very publicly announced that they were going to now consider selling their oil exports in currencies other than U.S. dollars. If this really is the beginning of the end of the petrodollar, isn't that going to be, at least from a fundamental perspective, also very bullish for metals?
Yes, it will. And, that's what a lot of people think happened with the Iraq War 20 years ago. It was really about Iraq threatening to sell their oil in non-U.S. dollar currencies, and it led to war. So that's a theory out there. I kind of think it might have been true. And if that's the case, if they're going to start selling oil outside of U.S. dollars, there might be a response from the United States, and it could mean a geopolitical war.
So the BRICS countries, Brazil, Russia, India, China, South Africa, have very publicly announced also that they will be pursuing their own currency to use in trade, at least amongst those countries. There just seems to be this big move away from the U.S. dollar, really, in earnest since 2020. What are your charts telling you about the U.S. dollar?
Well, let's see. The U.S. dollar, I'm going to have to go pull my chart up here. Okay, the dollar is right now, it's oversold. Now, the dollar is interesting because it moves in the opposite direction to the S&P 500. It's short-term oversold, which means that it is due for a little rally here, more than a little rally, and the S&P 500 should move in the opposite direction. So that means that's bearish for the stock market. But it's dropped from 115 a dollar down to almost 100 in the last, few months, and so it's due for a rebound. But I do see it going much lower over the next year and a half. That it's going to track a wave 2 move down. But short term, I think it could rally for a while, and that would be coinciding with a stock market drop.
And Bob, for listeners that maybe aren't familiar with the whole idea of the market moving in waves, which I believe is a theory put forth by Elliott, I believe it's called the Elliott wave theory. Correct me if I'm wrong, but could you just give our listeners just a bit of a crash course?
Well, yeah, Elliott created a theory of market movement where stocks progress in 5 waves, and then they correct that progression in the opposite direction in 3 waves. That's an oversimplification, but that's basically it in a nutshell. And you just count the waves, you track them. And, when you see an impulsive move and progression in a particular market instrument, you can count 5 waves almost every single time. And it goes, very vertical. And then what happens is it reaches that 5th wave, the top of it, and then it will consolidate or regress in the opposite direction. And usually 3 waves. It can be other patterns, but for most part that. And then it hits the bottom of that 3-wave correction, and then it continues again in the progression it originally started in 5 another waves. So that's it in a nutshell.
So, Bob, as the dollar over the long term, according to your forecast, as the dollar weakens, is there another currency that will be the beneficiary of this dollar weakening, or do you see the beneficiary being metals, or is it some of each?
The euro operates in opposite direction of the dollar. So almost, I did a correlation analysis in my last weekend report, and it's almost tick for tick. It's amazing. So the euro and the S&P 500 are moving in the same direction, and the dollar moves in the opposite direction of those two. So you'll kind of see a give and take correlation on those instruments, which is kind of interesting. And the euro right now is overbought, so it's due to decline, and as is the S&P 500 is overbought, so it should be declining with the euro over the coming months. As far as gold correlation with the dollar, I don't know if it's going to be direct. I really don't. There could be some break off. My concern with the dollar or with the gold is it's just stuck in this sideways pattern for 3 years of this handle. And it just seems like there's a lot of forces at work that may even be manipulation that are just causing a tug of war. I would think that it should have been exploding higher by now with the inflation we had, with the overdollar accumulation that the Fed printed off, and it hasn't. It should have exploded. It didn't. That tells me there's manipulation, and the pattern talks about sideways move, lengthy sideways move in this handle. So it's kind of where I lean toward the pattern, the technical pattern for guidance, and I have to leave the fundamentals of it at this point and trying to figure out where it's headed next.
Well, a few years ago, those of us that said there was manipulation in the metals markets would have been branded conspiracy theorists, but now there's been a couple banks that have actually gotten caught with their hand in the proverbial cookie jar, so to speak. And we know manipulation does happen and has happened and probably is still happening.
Yeah, that's right. Especially metals. I mean, metals are, I don't know, it's strange. Some nation wants to back up their currency with gold, and China or somebody, and they start buying the crap out of it, and it's kind of like that's a manipulation. It's just an over demand for a product that's got limited supply, and so it's kind of got a strange way about it at this time.
Well, my guest today is Dr. Bob McHugh. His website is technicalindicatorindex.com. I'd encourage you to check it out. I'll continue my conversation with Bob when RLA Radio returns. Stay with us. Welcome back to RLA Radio. I'm your host, Dennis Tubergen. I have the pleasure today of chatting with Dr. Robert McHugh. If you're just joining us, Bob's website is technicalindicatorindex.com. Bob publishes an extremely extensive daily and weekend report on the markets. I have followed his work for many years and always enjoy catching up with him here on the program. And Bob, before we jump back in, I know you have a platinum trading program that I've been following a bit as well. And frankly, I'm impressed. Do you want to share a little bit with the listeners as to what that's all about?
Well, thanks, Dennis. Yeah, what we have done is basically because our subscribers wanted it, is a way to make an additional income stream off of the work that we do, tracking where the markets are headed and the projections and so on that we have with our charts or indicators and so on. And so back in 2011, we started an options trading program, which also includes an ETF trading program. We call it our Platinum program, where we do investing in options and ETFs to generate an additional income stream. And we share in real time what we're doing for ourselves with our customer base who become members of this program. And it's up to them whether they want to look at it as entertainment whether they want to talk to their financial advisor and do something similar, or just look at it as education. And we've been very successful. 10 years, we've made almost $1 million in the program through this trading program, and we're continuing to operate it now, and it's growing. People seem to like it, and we do our very best. Our success rate's about 75 to 80%. We do have some losses from time to time, but so far it's been going pretty well, and it's a way, like I said, for people to try to get an additional income stream to whatever else they have going in their lives right now.
Well, great. And again, the website, technicalindicatorindex.com. So, Bob, when it comes to stocks, particularly U.S. stock markets, it seems that even after last year, the majority of investors seem to have a buy the dip mentality. They believe that, the Fed's not going to quit supporting the markets. And, overall, correct me if I'm wrong, but overall sentiment still seems to be pretty bullish despite a pretty miserable year last year. That usually means more downside for stocks. What say you?
Same thing. I agree with you 100%, Dennis. That's the way I see it. Sentiment should be more bearish. It has not been. The market fell for 9 straight months from January through the end of September, and then that was a big wave down, and then it's been correcting since the end of September and early October through now. So you had 9 months down. We have had 4 months up. The rallies from late October have been a lot of overlap, and that's one of your key signs that it's corrective. It's a lot of overlapping waves. It probably extended a little longer than I thought it would, which means it's a larger degree correction than we originally might have thought. But it's set up to decline. A very interesting thing, we came up with our charts. If you touch the tops of all the rallies from last January through now, there's a beautiful, perfect trend line that touches every single one of these tops, and it has stopped every single rally. So it's a very powerful resistance trend line going down. And what's interesting right now is that the market just recently touched that top again. And this is evident in the S&P 500, in the NASDAQ 100, and in the transportation average. So we're reaching that point now where there's a high risk, high probability of a top here and another decline in the short run. But we're in Grand Super Cycle Degree Wave 4. This thing, the Grand Super Cycle Degree Wave 3 topped it last January, a year ago, and now we're in 4. And 4 is a major decline. It's not a shorty. It's bigger than the Great Depression. It's at a higher level of degree of trend. And so this is a very dangerous setup here. And the buying the dip mentality has been brainwashed because of the last 10 years that it is going to be successful. And it has been from time to time. But this is a different ball game. And at some point very soon, we're going to see a wave, some intermediate degree wave 3 down within this Grand Super Cycle Degree 4. And 3s are the worst waves. They're the most dramatic. And so I'm looking for that to start not in the not too distant future, in the next several months.
Bob, when you there was a lot in that last comment, so if I could, I'd like to go back and maybe drill down on it a little bit. You used the term Grand Super Cycle Degree Wave, and you said 3 just finished. We're now starting 4. Can you explain to the listeners again what that means? What does Grand Super Cycle Degree Wave mean?
And you're doing your Elliott wave work, you have what they call fractals. You have the largest degrees of trend that go back over several hundred years, and that's the Grand Supercycles. The Grand Supercycle Wave 3 started in the 1700s. It just ended a year ago. So the correction of that Grand Supercycle 4 down will be a proportional decline, so it's going to be huge. The Great Depression was a degree lower. That was a super cycle degree back in the 1920s. That was a degree below the Grand Super Cycle. That was a super cycle. So you have several levels of degrees within each degree that create what we call fractals or subsets within each degree. Think of it like a tree with branches, and each branch has smaller branches, and each smaller branch has springs of even smaller branches. It's kind of that scenario. Well, now we're talking with the big major branch here. This is a biggie. And so what we've seen in the last 12 months is just a tip of the iceberg of where this thing is headed, based upon this theory of Elliott wave analysis and based on pattern charts that I have. I mean, I have broadening megaphone tops that have been going on for a decade, for several decades, for 10 years, that are calling for a massive stock market decline that has not started yet. It's just basically beginning. And by the time it's ultimately done, we're going to see levels, below what we saw back in 2008. But that's kind of how it's set up right now with patterns and Elliott wave theory, two different theories, all saying the same thing.
Well, Bob, and that's a big statement, because if we're going to see levels below what we saw in 2008, I mean, from these levels, just doing some math off the top of my head, you're forecasting then maybe as much as like 80 or 90% more downside here. Is that fair?
Yeah, that's what the charts are telling me. That's exactly right. Charts have been right. I mean, these patterns and charts are almost always right. Yeah, they may be delayed a little bit further than what the original forecast might be, but they're right almost all the time. These patterns are very highly reliable. And yeah, that's the target. And now what would cause that to happen? I don't know. Russia drops a nuclear bomb on Ukraine, scares the crap out of everybody. We go to war with these countries that are going to leave the petrodollar and go to their other currencies for oil exchanges. Some kind of pandemic that we don't even know about that's greater than what we saw before. Who knows? But the charts are saying something's going to happen in the world that's going to draw prices down dramatically over the coming years. We're not talking weeks, we're talking years.
Well, Bob, when you look at just worldwide debt levels, fundamentally your forecast certainly is backed up by fundamentals. I think I read some data that at the time of the financial crisis, worldwide debt was 100 trillion. It's now 300 trillion. So, I mean, the very problem that caused a lot of the issues at the time of the great financial crisis have just gotten worse. So, I mean, the next bust really has to be worse.
Yeah, that's a good point, and that's a good fundamental economic reason for a continuous major decline. Yeah.
So, Bob, let's shift gears a minute, because last year, a lot of investors that owned U.S. government bonds, which were presumably very safe, many of them lost a lot of money. What's your forecast for U.S. Treasuries moving ahead?
Yeah, I mean, I think it was the greatest decline in the value of our Treasury notes and bonds ever, I believe, if I'm right, in 1 year. So it was caused by hyperinflation that shocked the system, and the Fed's aggressive action to try to raise interest rates at historically fast, rapid levels and great levels. I believe that was also the highest ever that they used. And again, all they're doing is taking out aggregate demand. The real problem is supply. The real problem is we have shortages. We can't get cars. We can't get houses. Food is up 50, 80%. The 6% they just reported is nonsense. Our electric bill just went up 50%, crying out loud. So, but as far as the Treasury, what we got here is there's going to be a point where the Treasury yield reaches its peak, because it'll happen when the deepness of the recession becomes evident. And then it's going to rally, and we're going to see a robust rally in the Treasury. And I have a converging fan trend line pattern that gives a target. Right now, the U.S. Treasury 10-year is at around 115. And this converging fan trend line pattern it has a target of 140, which would mean substantially lower interest rates. But that's not going to come until the recession has already wiped out a lot of wealth in this economy. So that's a later development, maybe in 2 years, maybe in a year and a half. So I do eventually see interest rates dropping. Again, it's going to be part of the correction or the fix that they try to put on for what the damage is being done right now to everybody's household wealth, commercial wealth, and the recession that's building right now.
So as interest rates have come back up dramatically over the past 12 months, Bob, there's a lot of CD investors, a lot of investors that like time deposits that, are finally seeing some interest rates that are a bit more attractive. Certainly they're lagging inflation yet. Uh, but do you see more upside for those types of investors? Are we going to see higher interest rates before this reversal comes? What's your take?
Yeah, it's interesting. The 10-year Treasury has not been rising in tandem with the short-term interest rate rise that the Fed has put through. There seemed to have been like a bottoming here. And I have a converging fan pattern that kind of indicated, yeah, it's bottomed. So I don't know if we're going to see the 10-year rally or rate rise, 10-year interest rate rise a whole lot more. Because I think what's happening is the evidence of the recession is starting to kick in. Earnings for corporate earnings are dropping. I don't hold out a lot of hope that CD rates are going to rise a whole lot more. I think we might be close to a max here. But that doesn't mean everything's going to go great. The reason we're at a max is because everything's going to go poorly in the economy. And then we're going to see a flip in the rates. But that's just what my charts are showing me on the bonds and rate and the Treasury, 10-year Treasury right now.
Well, my guest today has been Dr. Robert McHugh. His website is technicalindicatorindex.com. I would encourage you to check out his work. Bob, always a pleasure to catch up with you. Always appreciate your perspective and certainly appreciate your hard work as well. And love to have you back down the road.
Oh, thanks, Dennis. I love speaking with you. Always learn a lot myself from you, and look forward to hearing back from you again and being on your show. Thank you very much.
We will return after these words. Welcome back to RLA Radio. I'm Dennis Tubergen, your host, and thank you again to my special guest today, Dr. Robert McHugh, for joining us on today's program. Hey, if you're just joining me, it is the last opportunity for you to get the January 2023 special report titled Two Possible Outcomes. The report talks about the two options that the Federal Reserve, the central bank of the United States, has, in my view. I believe, as I talked about at the end of the first segment, that the Fed will have an opportunity to preserve the purchasing power of the dollar, or they will have the opportunity to save the financial system and the economy, but it's unlikely that they can do both. So the report for January, titled Two Possible Outcomes, will give you not only the detail relating to these two choices, but also some strategies for you to consider moving ahead. When you request the report, I'll be very glad to send you bonus information as well. All you need to do to request the report and all the bonus information is visit requestyourreport.com. The website again is requestyourreport.com. I want to give you some information in this segment that if you have student loans and you're thinking about collecting Social Security, my guess is it might be news to you, and that's why I bring it up. There was an article published in Insurance Newsnet this past week that was very educational. And if you have student loan debt, maybe you were among those that were hopeful that your debt would be forgiven. Now, at this point, that seems rather unlikely. And the new reality as far as student loans is that if you carry student loan debt with you into retirement, your Social Security benefits can be reduced to pay back your loan. So this is essentially a garnishment of your Social Security benefits. So let me give you just a bit from this Insurance Newsnet article, because again, it's my hunch that many of you are not familiar with this. While the promise of student loan debt relief seems to slip further out of reach, the prospects of the debt coming back to bite people in their retirement grows. That's because student loan debt delinquencies can be deducted from Social Security benefits to the tune of thousands of dollars per year. The number of debtors is rising along with delinquencies, according to a recent study by Boston College's Center for Retirement Research. In fact, student loan delinquency rates have surpassed all other types of consumer debt delinquencies between 2012 and early 2020. That trend is accelerating. That means more Americans will see their Social Security benefits shrink. Now, if you're wondering how much they can take from your Social Security benefits to pay back your student loan, the withholding amount is the lesser of 15% of the Social Security monthly benefit or the amount by which the benefit exceeds $750 a month. So if you're collecting $2,000 a month from Social Security, $300 of that can go to pay back your student loan. Now, if you want to look at averages, the deduction across the board is an average of $2,500 annually, and it amounts to a 4% to 6% decrease in benefits, according to the study. And again, that study was conducted by Boston College's Center for Retirement Research. So here we have this period of time where we have inflation, and we also have a time that if someone is struggling to make ends meet, trying to make student loan payments, pay the rent, buy the groceries, buy prescriptions, maybe make a car payment, now they could see their Social Security benefits shrink in order to make payments on their student loan. Now, most of the delinquencies on student loans are among younger borrowers. So it may be a while before this kicks in, but it's certainly something that you need to be aware of, and it's certainly something that will be a bit of an economic headwind moving ahead. Now, finally this month, this is a bit off topic, but if you're planning a trip to Europe, I have some news for you. Summit News reported that as of January 24, a food additive made out of powdered crickets began appearing in foods from pizza to pasta to cereals across the European Union. And yes, I have verified this. Defatted house crickets are on the menu for Europeans across the continent without the vast majority of them knowing that it's now in their food. Now, the European Commission passed this ruling earlier this month, and I'm quoting from the news article. As per the decision, which cited the scientific opinion of the European Food Safety Authority, the additive is safe to use in a whole range of products, including but not limited to cereal bars, biscuits, pizza, pasta-based products, and whey powder. The article also says, don't worry, because the crickets first have to be checked to make sure they discard their bowel content before being frozen. Now, the idea of eating crickets doesn't sound that great to me. I've used them as bait to go fishing, but I've never been tempted to eat one. Now, the European Union also recently approved the use of the lesser mealworm for human consumption. We can only hope that that doesn't show up here. At least that is my humble opinion. As I close this program, again, it's your last week to get my January special report titled 2 Possible Outcomes. If you'd like to get a copy of the report as well as all the bonus information, just go to requestyourreport.com and I'll be glad to send you a box of information that I think you'll find to be useful. Again, the website requestyourreport.com. That's my program for this week. Hope you got something you can use. I'll be back again next week, and my special guest will be Dr. Charles Nenner. Be sure to tune in.